We've all heard that the wealthy pay less in taxes, but I'm going to show you how they do it legally by understanding how the tax law isn't just a revenue model, more of an incentive program to get business owners to do the things that the government doesn't want to spend time or money on. Welcome back. We're going to talk about taxes, business, and how all of that relates to you as a real estate investor. Because I'm not an accountant, I highly recommend that you talk to an accountant before you try to apply any of the strategies that I'm going to share with you today. As we've discussed in previous videos on this channel, the public education system has been set up to teach us how to be employees, not necessarily business owners. Because this is how we're all taught, everything that comes along with being an employee, including how we're taxed, seems perfectly normal. Let's dive into this and examine why the wealthy generally pay less in tax as a percentage compared to employees. In my study that led to the writing of my 4 times Amazon #1 best-selling book, Mindset to Millionaire, links in the description, I found an amazing consistency among the successful people that I studied. The wealthy are business owners and real estate investors. And when I first discovered this, I thought, well, sure, that's the case because those activities make a lot of money, right? Well, that's true, but what I found was there's layers to it. And one of those layers is taxes. Now, we've all heard that the wealthy pay less in taxes. Did you know that most of them do it legally? It's because they understand the tax law. You see, my 5 currencies of the wealthy, time, knowledge, relationships, credit, and money, that second currency, knowledge, it's a very important thing to the wealthy. They have this funny attitude of, if I'm gonna pay into a system, I'm gonna understand it. And what happens when they start to understand it is they find that being a business owner and a real estate investor carry with it more deductions than any other activity. There's nothing else you can do that has more tax deductions than being a business owner and a real estate investor. The reason for this is the difference between being a creator and a consumer. It's simple. If you're creating jobs and housing for people so that the government doesn't have to, the government provides an incentive to do these things in the form of a tax deduction. The employee mindset individual was taught all their life to be consumers, to buy liabilities instead of assets, to be scared of finances. They don't understand it. They don't want to talk about it. They don't want to ask questions about it. And most of them, maybe with the exception of accountants, don't study the tax law to gain understanding. They trade most of their time for money at a job where they are required to file taxes as a W-2. There's not another more expensive way to pay your taxes than the W-2 form. The reason being is it has the fewest deduction categories. It's also the only way whereby the government gets paid first. You know that withholdings thing that they do where the government gets their money before you get your check? Yeah. Okay, so let's set up a hypothetical example to help me illustrate my point. Let's say you're a W-2 employee who makes $100,000 a year. I don't know, selling widgets. You work for Widget Manufacturing Incorporated. As a W-2 employee, your job is to go out and pick up new customer accounts and sell them widgets. As a W-2, the first thing that gets taken out of your check is taxes. On average, we'll say about 30 to 33% that gets taken out. So 30 grand immediately goes to the government. Now, you've got a house and a cell phone and a car. You've got kids, so you got to pay for those kids' school and their soccer practice and all that stuff. Your expenses come to about $70,000 a year. Okay, what's left over? Nada, zero, zilch. Now, let's run that same scenario, but this time as a business owner. You've decided, you know what? I don't want to work for Widget Manufacturing Incorporated. I want them to be a vendor of mine. And I'm going to start my own company, and my company is going to be responsible to sell their widgets. And we'll contract with Widget Manufacturing Incorporated to fulfill all the orders that come through. You've got the same clientele, you make the same profit margin and commission. In this scenario, you also bring in 100 grand a year. The big difference is that as a business owner, your taxes don't get taken out first. As a business owner, you get to take deductible expenses first. Business owners get to take advantage of more deduction categories than W-2 employees. W-2 employees have 15 to 20 deduction categories that they get to take advantage of each year, whereas business owners have more like 250 categories, and real estate investors get another roughly 200. So, do you think as a small business owner, you might use your cell phone a little bit for business? Yep, there's a deduction. Do you think as a business owner, you might do a little bit of work out of your home? Yep, there's another deduction. All right, maybe you use your car a little for work, driving around to service your clients and your customers. Yeah, there's another deduction. What about those kids? How do we write off the kids? You know what? The tax law actually allows you to hire your kids that are under the age of 18 as long as they are dependents living in your household. You can pay them up to around $12,000 a year each tax-free. So rather than giving your kids allowance and then paying for their school supplies and their soccer practice and their clothes, all with post-tax dollars, pay them $12,000 a year tax-free to work in your business. Now, they actually have to do work, and you actually have to pay them for all of this to be above board. But when it comes time to buy their clothes and their school supplies and pay for their field trips and their soccer practice, have them do it. They have a job, and now you're paying for that stuff with pre-tax dollars, which basically works just like a deduction. What about groceries? Groceries are not directly tax deductible, but there is no law that says your kids can't contribute to the household. Let them take turns paying for the groceries in the household. Now you're paying for groceries with pre-tax dollars. If you have children under the age of 18 living as dependents in your household, think about how useful that can be on so many levels. Teaching them the importance of working for what they get. Teaching them solid business strategies at a young age, not to mention structuring some responsibilities for them to help take some of the load off of you and your business. And that strategy applies per kid, up to $12,000 a year, tax-free per kid. I mean, I live in Utah. For some of the people I hang out with, that could translate to hundreds of thousands of dollars each year. Back to our example. So now, using strategies like the one I just explained, your deductible expenses are about $70,000 a year. And you know what's cool? Business owners don't get taxed on their gross income like W-2 employees do. They get taxed on what's called their adjusted gross income, or AGI. The equation to calculate your AGI is very simple. It's gross income minus deductible expenses. So in this example of your gross income being $100,000 and subtracting $70,000 in deductible expenses, you're left with an AGI of $30,000. As a business owner, that's what you're taxed on. You're taxed at 30 to 33%, so your tax bill for the year is $10,000. What's left over in this case? $20,000. You made the same amount of money doing the exact same thing and spent the same amount of time and money on the same stuff. You just structured it differently. When knowledge increases, behavior changes. Anyone want to save 20 grand on their taxes this year? Now, I get it. You might be looking at this saying, well, geez, I don't make 100 grand a year. I make like half that. Well, that's okay. This is completely scalable. Cut that in half. Anybody want to save an extra 10 grand in taxes this year? You don't need to be rich to do this. This is something you can start doing right away, regardless of your income level, as long as you're educated enough to do it correctly, legally, and safely. I'm not advocating that you do anything shady or illegal here. Quite the opposite. I'm suggesting that you take the time to educate yourself on how the tax law works and to navigate it legally, morally, and ethically so that you can start to take advantage of some of the tax strategies that the wealthy do. Of course, there's still risk in real estate. And I'm not your attorney and I'm not your accountant, so I'm not qualified to give you direct advice that would be applicable in your exact situation. These are just some of the things that I've picked up along the way that I've found success with. There's always risk in any of these strategies, so make sure you're educated before you go out and try any of them. A great place to start is our weekly live education webinar. Get access to our nationwide community of real estate investors. We meet on Zoom every Wednesday at 7 p.m. Mountain Time for exclusive trainings, real deal walkthroughs, question and answer, guest speakers, and all around real estate investor shenanigans. There's no better place to start getting your investor legs. And best of all, we made it free just for you. I can't wait to talk with you live. I'm curious what you thought of this episode of Flippin' Education. If you have any thoughts you'd like to share, or if you would have done things differently, please comment in the comment section below. I'd love to hear from you. If you like this video, please smash that thumbs up button. It's an easy and free way to help support the channel. Also, be sure to subscribe and ring that bell, as we will be bringing you more of this amazing content very soon. We'll see you on the flip side.